Hi, it's me, Bob Jolka with Hunt Real Estate. I've been selling real estate in Central New York for over 20 years. Welcome to my YouTube channel, devoted to helping the general public understand everything that goes into buying and selling homes. Today we'll be talking about mortgages with Christina Bertrand from Hunt Mortgage. Hi, Christina.
Hi, Bob.
Thanks for coming in today and sharing your knowledge about mortgages. And so why don't you just tell us a little bit about yourself and about Hunt Mortgage?
Yeah, thanks for having me. So Hunt Mortgage was founded in 1984. We're a local lender, a branch off of Hunt Real Estate, founded in 1911. I'm a local CNY native, so I was born and raised in Liverpool, New York. That's where I currently live. I've been with Hunt Mortgage for the past 5 years and absolutely love it.
All right, and Christina does a great job. I can attest to that because a lot of my clients have used Hunt Mortgage and have gone through Christina, and they've been very happy.
Thank you.
So there are several types of mortgage products out there. What goes into people qualifying for the different products? What decides what products they're qualified for?
Yeah, so there are 4 major types of mortgage products. They are conventional, FHA, USDA, and VA. Depending on the borrower's qualifications, we kind of review them for all 4 options to determine what the best fit is going to be. We look at a variety of things. So we look at their credit score, their debt to income ratio, their assets, so how much do they want to put down, how much do they feel comfortable putting down, and then if they own any other real estate or what area they want to be in, so what part of Central New York or New York in general.
All right. So let's go over the various mortgage products that are out there. Give a little more detail so that buyers know what they, if they qualify for a certain type of mortgage, how much do they have to put down, how much can they finance, what other kind of expenses go into different type of mortgages.
Yeah, so every loan program has different requirements and different guidelines. So conventional is typically the first kind of mortgage that people normally think about when they think about a loan. A lot of people have a misconception that it is a 20% down requirement, and that's not the case at all. If you're a first-time home buyer, Hunt Mortgage actually offers a 3% down payment conventional loan. You do have to be a first-time home buyer to qualify for that program. If you're not a first-time home buyer, whether it's your second house or your 20th house, you can put as little as 5% down and then increase it from there based off your comfort level.
Okay. All right.
The second type of mortgage that people are really used to hearing is our FHA mortgage. This is the mortgage that I usually hear that people think you have to be a first-time home buyer to qualify for, and that's not the case at all. You just can't have 2 FHA mortgages at the same time.
Okay.
That down payment is 3.5% of the purchase price, and you can increase it from there based off your comfort level as well.
Okay.
The next 2 loan types are VA and USDA. Those are both government loans, just like the FHA product. VA is 0% down, and that's for veterans and people that have served in our military forces. The VA would determine your eligibility for the VA loan using your certificate of eligibility, but it is a 0% down payment program.
Okay.
And then the last is that USDA program, which is also 0% down. The house does have to be in a USDA specific area to be able to qualify for that. But if a borrower or consumer is looking at a house, it's very easy for me to pull it up and tell you if that home would qualify for that USDA product.
Okay, and probably a lot of people think that if it's a USDA loan, it's got to be for a farm or something, but it's amazing how many homes in just normal neighborhoods qualify for USDA loan, right?
Exactly. People hear USDA and they think, you've got to be in farm territory or something like that. In the Central New York area, there's areas in Lysander, areas in Brewerton, Bridgeport that qualify for that USDA program. So it's not as agricultural as a lot of people think. And it's a great program, 0% down. And like I said, you could put more down if you felt comfortable with that.
All right, great. When you say for a first-time home buyer, they can get a conventional mortgage for 3%, that's less than what you have to put down for an FHA mortgage.
Exactly. So it's a little less, so 0.5%. Yep, FHA is 3.5%. Conventional is 3%. So we would look at a few determining factors as to why somebody would want to go conventional to FHA. In that situation, it's usually based off credit score or debt to income ratio.
Okay.
But we would review both options with them.
All right. And so are there different underwriting guidelines for different mortgage types?
There are. So all 4 of the mortgage types have different underwriting guidelines. Conventional, FHA, VA, and USDA all have different underwriting guidelines. For example, FHA loans will take a lower credit score and higher debt to income ratio than a conventional loan. VA, they have different requirements as far as the debt to income ratio and credit scores as well. And then USDA is the same thing. So
Okay. And what about rehab loans? I know there's a lot of people that now, we haven't had any foreclosures, so to speak, over the last year because of the COVID situation, but that moratorium on foreclosures isn't going to last forever. And there's a lot of buyers out there that they're on a budget and they want to buy a foreclosure, but sometimes those foreclosures aren't in the best condition. What could they do in order to buy a so-called distressed property and be able to finance it and fix it up so they can live in it?
of course. So we do offer a rehab loan product. It falls under the FHA umbrella loan type. It's called our FHA 203K loan. What it allows you to purchase the home for that set purchase price, and then it also allows you to roll in repairs. So let's say you go see a home and it needs a new roof, for example. It would allow you to roll in that roof repair. So what happens is you close on the house, and then the money for the repair goes into an escrow account, which is set up by the attorneys. An escrow account is just kind of like a savings account that the attorneys would set up for you. And then after closing, the repairs get done and the contractor gets paid from there. A little information about 203K loans. You cannot do the work yourself. So if you're looking at a fixer-upper that you could do the work yourself on, unfortunately, you wouldn't be able to do that under a 203K loan. It does have to be a licensed contractor that does do the work. They do take a little longer to close than your standard, conventional or FHA loans. On average in New York State, we're seeing about 45 to 60 days for closings. A rehab loan is going to take closer to 90 to 120. Okay. However, if you're not in a rush to move, it could be a great product for you, especially if the house needs a little updating. And it doesn't have to be a huge repair either. So maybe you find a home that the kitchen's not as updated as you want, or the bathroom's not as updated as you would like. You can use it for, simple upgrades as well.
Okay.
Yep.
All right, and those loans are strictly for owner occupants?
Correct. It does have to be your primary residence. So you would have to live in it as your primary residence to be able to qualify for it.
Okay, so an investor wouldn't be eligible for a 203K loan?
Unfortunately not, no.
Okay. The different underwriting guidelines for the different type of mortgages, do they make a difference when it comes to the lender's appraisals?
It does. So we do require appraisals for all four loan types, the conventional FHA, USD, and VA. VA loans and FHA loans both have additional inspections, an FHA inspection or a VA inspection on top of the appraisal. The appraiser completes the inspection, and it's very important to realize this is completely separate than your standard home inspection, which usually happens right after you sign the contract.
Right.
The FHA and VA inspections are really kind of flagging safety issues. Chipping and peeling paint, handrails, things along those lines are typically what we see from those. Okay.
And so what happens if an appraiser flags something like a broken window or peeling and chipping paint? What happens in that case?
Yeah, so once we get the appraisal back, if there is a required repair, I send out an email notifying both agents, so on the buying side and listing side, of the needed repairs. Typically it's in the contract as to who's going to pay for any repairs up to a certain dollar amount. So the agents would help negotiate that. Once the repairs are completed, they let me know, and the appraiser has to go back out to verify the repair has been completed and then sign off on it.
Okay, so the repairs can't be put off until after closing. They can't put, for the most part.
So if they are outside repairs in the winter time, we have something called an escrow holdback that can be reviewed.
Okay.
So for example, especially in central New York, if there's an outside, scraping and painting repair and it's the middle of January, that's probably something that's not going to be able to be done.
Sure.
So what they will do is they'll assign a value to it. So let's just say it would cost $200 to scrape and paint this portion. And then that goes into an escrow account and gets released once the repair has been completed in the springtime.
Okay. All right, so in that case, those repairs can be put off until the weather permitting they can be done.
Correct.
And,
if they're outside
and the
repairs.
buyer can still close on the house and move in and not have any problems.
Exactly. Yep. And that money just sits in kind of like that escrow savings account.
Sure.
And then once we get confirmation they've been done, we send the appraiser back out there and the check gets released.
Okay. All right, great. So really, based on the type of mortgage that someone's getting, that can have an effect on the seller as well because of the possibility of required repairs.
Exactly.
Like the conventional mortgages aren't as strict as far as the appraisal is concerned, where the FHA and the VA have their own specific guidelines.
That's exactly right, Bob. And especially in this market that we're seeing in central New York right now, that is one of the reasons I feel that conventional offers are a stronger offer to go in with, especially in a multiple offer situation, which we're seeing more and more often right now.
Sure, because it's one less thing that the seller has to worry about.
Correct, yep. It's one less thing that could come back and delay the closing or, put off the closing.
Okay, so can you give us a little insight into some of the various terms that you use? There's a certain vernacular in the mortgage business that the average person probably doesn't understand what those things mean.
Yeah.
The average consumer might not know what debt to income ratio is, or what a FICO score is, or things like that.
Yeah, so I can definitely go over those. So what a debt to income ratio is, it sounds simple, but it can be a little more confusing. So for the person that's not in the mortgage industry, that's not doing this, what I tell borrowers when I talk to them is, how often are you buying a house? Of course you may know this. That's what I'm here for. It's what I'm here to talk to you about. So debt to income ratio, we look at your monthly income. So it is before taxes, so your gross income, whether that's W-2 income, Social Security, retirement, self-employment. There's lots of different factors for that. And then we look at your monthly debts. The monthly debts we look at are what's reporting on your credit report. So any loans, any credit cards, any lines of credit. We do not consider utilities or, your phone bill or insurances or, those debts in that debt to income ratio.
Okay.
Different mortgage types do have different guidelines on debt to income ratios that they'll take. FHA and VA loans will take a higher debt to income ratio than a conventional loan or USDA loan would. There isn't a set number just because they review it also based off your credit score. So a borrower with an 800 credit score, they might be qualified for a higher debt to income ratio than with somebody with a lower credit score.
Okay. And what about MIP and PMI?
Yep. So that's mortgage insurance, and you might hear it both ways. PMI stands for private mortgage insurance. MIP is mortgage insurance premium. So they really kind of both, I don't want to say equal the same thing, but they both kind of come out the same in the wash, if that makes sense.
Okay. And when does somebody have to get mortgage insurance?
Of course. So conventional, you have mortgage insurance until you pay off 20% of the principal. So if you put 20% down, you never have mortgage insurance. If you put 3% down as a first-time home buyer, once you pay off an additional 17% of the principal, it comes off for you.
Okay.
FHA loans, you have mortgage insurance for the lifetime of the loan, regardless of the down payment. So that is always on there. And then VA and USDA loans do not have mortgage insurance on them.
Oh, that's great.
Yeah.
That's great.
Yep.
The so how much a month, what decides what the premium is for the mortgage insurance?
Yeah, so it's calculated a little bit differently. Conventional uses both a mix of your credit score, your debt to income ratio, and your loan amount for mortgage insurance. What we do is we shop mortgage insurance companies for conventional loans. and they provide us quotes back for you. FHA loans, it's a set, and it's going to be based off of your loan amount.
Okay.
Yep.
All right, great. So how should potential home buyers prepare themselves for qualifying for a mortgage?
Definitely. I always say, even if you're looking 3 months from now or you're looking a year from now, I always say the best starting point is starting that pre-qualification process. Because even if you're not looking until next year or this fall, it's good to check your credit, see what's on there, see what improvements you can make. That way you're in the best possible position for when you do start looking. For example, we would check your credit if there was anything negative on there or anything you could do to improve your credit score. Because the higher your credit score gets, the lower your interest rate is going to be, and that's going to directly affect your monthly payment too.
So the people with the highest credit scores get the best interest rates.
That's exactly right. Yep.
Okay.
So, and that directly affects your monthly payment, and who doesn't want to keep their monthly payment low?
Well, absolutely, and cash flow is king.
Exactly.
So when you talk about people getting pre-approved, there's different types of pre-approvals out there. You hear people say, well, I'm pre-qualified, or they say I'm pre-approved, and Hunt has a pre-purchase mortgage commitment. So they're all 3 different kind of variations on that. Can you explain what the difference is between those?
Definitely. So there's 3 terms that we kind of hear, like you said. There's your pre-qualification, your pre-approval, and then like you stated, Hunt Mortgage offers what's called a pre-purchase commitment program, which is something I'm extremely passionate about. So a pre-qualification is just, I talked to you over the phone, you verbally told me your income, you verbally told me your assets, but I have checked your credit report. So I do know your credit score and your monthly debts. At that point, we issue you a pre-qualification letter for the loan type that you qualify for that best suits your needs. Once I email you the pre-qualification letter, I include a list of documents in the email that I would need back. You can email those back to me, you could fax them, you could drop them off at any Hunt office, mail them, whatever is most convenient for you and your schedule. Once I have those documents back from you, I can issue what's called a pre-approval letter. The pre-approval, we have the documents, I verified that you make what you told me verbally you make, I verified your assets. Once I have those documents, I submit it for what's called a pre-purchase commitment program. What I refer to it for most people is an official approval letter. It means the underwriters reviewed all of your documents and signed off on it and has issued a commitment letter with a TBD address. That commitment letter is your official approval. Typically, on contracts, once you find a house, you put that commitment due date for right around 30 days out for the most part. But Hunt Mortgage offers this program. That way, you can get that pre-commitment before you even find a house, and we would just update it once we had that contract.
Okay. And of course, so they can get pre-qualified just over the phone.
Exactly.
So if there's people that decide that, boy, we really want to buy a house, we need to, first off, you need to find out how much you can afford before you start looking at houses. So obviously you want to contact a mortgage person and get at the very least pre-qualified. They could call you up and they could just give you their information over the phone, and that you could at least get them a pre-qualification so they know what price range they're in and they can actually start looking.
Exactly, and it takes 10-15 minutes for me to do the pre-qualification over the phone. We also offer an online application. My personal preference, I like to talk to people just because I want to know not only, hey, this is what you qualify for, but I like to find out what their needs and what their wants are from their mortgage, their payment, their closing costs, all of that.
Okay, so it's one thing for buyers to find out what they're qualified to buy, and you can pretty much give them an idea of what that monthly payment's going to be, okay? Because a lot of buyers are keying on their monthly payment and not necessarily the purchase price, but they want to be in a certain area as far as their monthly payment.
Exactly.
But a lot of buyers have no idea what their closing costs are going to be.
Yep.
So can you go over what buyers' closing costs are and how much the average buyer should really be prepared to have, before they commit to a purchase?
Definitely. So I like to go over what's called the cash due at closing, because I found that's really what people want to know and are interested in. They want to know, how much money am I going to need at closing, not just how much is my down payment, how much is my closing costs. So your cash due at closing is made up of three things. You have your down payment, if you have a down payment. Like I said, VA and USDA don't require one. You have your closing costs, and then in New York State, you have your first year of taxes and homeowner's insurance to set up your escrow account. We include all three of these items in that cash due at closing number. So the closing costs are going to fluctuate based off of the amount of the home that you purchase. Your closing costs aren't going to be the same for $100,000 versus a $200,000 home. They, of course, are going to increase. What the closing costs include is they include all your verifications and the appraisal fee. We include both your attorney fee. We do budget a set amount for it, but your attorney can, charge what they wish. We include the bank attorney fee. We include title insurance, both lenders and owners title insurance. We include transfer taxes through the town, and county. And then our processing and underwriting fees.
Okay. All right, very good.
And then you've got your first year of taxes and insurance on top of that, which could vary home to home, but I would, of course, budget for it. I personally like to budget worst case scenario, so I budget a little on the higher side, just because I'd rather give you a higher number than tell you it's less once you actually find a house.
Okay. And as far as the property taxes and the school taxes are concerned, the amount that the buyer would have to put in escrow at closing, that can be different depending on the time of year that they close, right?
Exactly, yeah. So we always budget for 12 months, and then your attorney will determine how much is going to be credited back to the sellers and how much is going to go into your escrow account. So right now in 2021, and the attorney will of course verify that the seller has paid their taxes for the whole year. But if you move in June, you'll have to pay the seller back 6 months, and then you'd put another 6 months into your escrow account, give or take.
So buyers should figure on putting a full year's worth of taxes in the escrow account. That at the very least that's going to be due that's one thing they know is going to be due at closing.
Exactly, and then the attorney will divvy it up between the seller and the escrow account.
Okay. Now, different kinds of mortgages have the ability for buyers to use what's called seller's concessions, and they can use that to offset some of their closing costs. Can you explain that and the difference between the types of mortgages and what kind of seller's concessions are available?
Of course, that's a great topic and one that gets brought up really often. So seller's concessions are a way for buyers to finance in part of their closing costs, down payment, prepaids. It just gets applied to that total cash due at closing number, so it just comes off the total. They are still paying for them, you're just paying for them over the course of the loan. So if it's a 30-year mortgage, you're paying for them over 30 years. FHA, the max that you can roll in is 6% of the purchase price. So on a $100,000 house, you can roll in $6,000 of your costs.
Okay.
On conventional, it's 3%. So on a $100,000 house, would be the $3,000. USDA is also 6%, and VA has no limit. So you can roll in all your closing costs for VA.
Okay.
The only item you can't roll in for VA is your homeowner's insurance. So in New York State, you need to have homeowner's insurance to be able to close on a property. So if you are getting a VA loan, you will have to pay for that out of pocket before the actual closing. Usually the attorneys will require it like the week before the closing table. Keep in mind, when you do roll in concessions, the house has to appraise for the full amount. So going back to that example, the $100,000 with the $6,000 in concessions, the house would have to appraise for that $106,000 for you to be able to roll that all in. Okay.
And I really hate the term seller's concessions because it makes sellers think that they're giving away something or that they're paying closing costs for the buyer, but in truth, the buyer is basically financing part of their closing costs. They're borrowing that money from the bank and they're paying the bank back with interest for that. The seller really isn't giving up anything.
Exactly. I hate the terminology too, because
Yeah.
I think it does cause confusion, just the way it's worded.
Sure.
If it was just closing costs financed into the loan, I think that would be easier for everybody to understand. But I completely agree with you. What I typically do when I'm talking to a borrower and they're thinking about making an offer and concessions, my first question is, how much do you want to give the seller for their house? And then I work based off of that number.
Sure.
Yeah.
Now, in the current market that we're in right now, because it's really a crazy seller's market right now, one thing that FHA buyers and VA buyers are running into is, because homes are selling for so much over their asking price already, to then add in closing costs, financing, so-called seller's concessions, there's no reason for a seller to even consider some of those mortgages, because they have to worry about the home appraising. And we've seen homes, $200,000 homes selling for $240,000 right now with no seller's concessions involved. So right now, being a seller's market, it's kind of difficult for a buyer to go in with seller's concessions. It's tough for them to be competitive. Now that's going to change, because nothing's permanent. The housing market is always changing, but right now that's the way it is. So Christina, one thing that we need to talk about is, how do you approach buyers when you talk to them about making major purchases before closing or before buying that house? Sometimes people want to buy all their new furniture before they move in. How do you counsel them about that?
Of course. Yeah, there's definitely things that you should not do during the mortgage transaction that could delay or hinder your transaction. You do not want to make any large purchases or have anybody check your credit. The easy way I tell people is, just don't give anybody your social security number. Even if it's for that 15% off at Target, it's not worth it, because it's just going to create more paperwork for you. The second thing is, if you are going to change jobs or your income is going to change in any way, just be sure to let me or your mortgage consultant know, so we can update your file and get ahead of it, if that makes sense. It might not cause an issue, but let us know, and we can update the file accordingly. The last item is, you don't want to make any large cash deposits or make any large transfers. Anytime you make a transfer to or from the account, we have to show where it came from. In large cash deposits, we have to prove where that cash came from, which can be difficult if you've got cash at home in a safe or under your mattress, something along those lines.
Okay. Well, what about a gift from a parent or a relative? How do you handle that?
Yeah, so gifts are completely acceptable. If you are getting a gift for your closing costs or down payment funds, that is fine. So we would just require a gift letter that I would send you. It's specific to the address. So that's why it's a specific form that we use. And then we need a copy of the bank statement from the gift donor's account showing the deduction. And then your statement showing you have those funds available once it's been deposited.
Okay.
But a gift is completely fine.
So there's a lot that goes into getting a mortgage. And knowing how much you approve for is extremely important, because how do you know how much house you can afford, what you should be looking at, if you don't know what you pre-approved for? So the bottom line here is that you really need to speak to a mortgage professional before you start house hunting. So if you'd like to contact Christina, who I highly recommend, I'll post her contact information at the end of this video, and you can reach out to her and talk to her about getting involved in getting a mortgage. She'll be able to help you with what type of mortgage you qualify for, what type of mortgage might be best for you and for your circumstances. Christina, thank you so much.
Thank you for having me. It was a pleasure.
I appreciate you taking the time. This information's been extremely valuable. So if any of you have any questions about anything we talked about today, please email me. My email address is right at the bottom of the video, and I will answer your questions as quickly as possible. And if I don't know the answer, you know who I'm going to go to. and we'll get that answer for you. So once again, please like this video, subscribe to my YouTube channel, feel free to share this video with anyone that you know. And as always, if I can help any one of you or anyone you know when it comes to buying or selling a home, please reach out to me. Stay tuned for my next video, and that's going to be regarding what is the abstract of title and what does it mean to me, because it means different things to buyers and sellers. So thanks again for watching. Have a great day and stay safe and well.